The number that should terrify you: in October 2025, China officially held $688.7 billion in U.S. Treasury securities. That sounds like a lot, until you rewind the tape. In November 2013, China held $1.316 trillion in U.S. government debt. That's a reduction of over $627 billion. Quietly, methodically, over 12 years. Now, here's the part most people miss. During that same period, China dramatically increased its gold reserves, expanded its strategic silver consumption, and built industrial systems that require massive amounts of physical metal, especially silver, to function. This isn't a headline. This isn't a trade. This isn't portfolio rebalancing. This is strategic behavior, and it follows a pattern that has repeated itself across history with brutal consistency. To understand what China is doing, you have to stop thinking like a retail investor and start thinking like an empire, watching another empire reach the limits of mathematics. The system we actually live in, the global financial system, is not abstract. It is built on U.S. government debt. As of today, U.S. federal debt exceeds $36 trillion. Annual interest payments crossed $1 trillion. Interests now costs more than national defense. Foreign governments hold roughly $8.5 trillion in treasuries. The dollar underpins tens of trillions in derivatives: oil, food, medicine, shipping insurance, microchips, all priced and settled in dollars. This isn't just America's problem. This is the architecture of global trade. So when the world's second largest holder of U.S. debt steadily reduces exposure while accumulating hard assets, the correct response is not panic. It's analysis. The four-stage currency cycle: every reserve currency in history has followed the same sequence. Not similar. Not close. The same. There are 4 stages. Not because economists designed them that way, but because human incentives don't change. Let's walk through them. Stage 1. Credibility. Every dominant currency begins with something real: gold, silver, land. Productive capacity. Military dominance. Trust earned through survival. The British pound rose because Britain controlled trade routes, industry, and gold. The US dollar rose after World War II because America was intact, productive, and explicitly gold-backed under Bretton Woods. At $35 per ounce, dollars were convertible into gold. That wasn't confidence. That was enforcement. This stage creates trust. Trust creates demand. Demand creates reserve status, and reserve status creates privilege. The exorbitant privilege. When your currency becomes the global reserve, something extraordinary happens. You can consume more than you produce. You can borrow endlessly. You can fund wars, welfare, and political promises using other people's savings. As long as confidence holds, the system works. But here's the fatal flaw. Stage 1 guarantees. Stage 2. Once a country realizes it can issue claims faster than it can back them, restraint disappears. At first, the justification is reasonable. War, infrastructure, stability, social cohesion. Then it becomes permanent. The U.S. began running persistent deficits in the 1960s. Vietnam, Cold War expansion, social programs. By 1971, the math broke. There were far more dollars in circulation than gold to redeem them. So the system changed not by reform, but by abandonment. The gold window closed. Convertibility ended, and the dollar became fiat. This wasn't a mistake. It was a political necessity. Because stopping would have caused recession, unemployment, political collapse. Continuing meant inflation, which could be exported. Every reserve currency chooses inflation. Every time. Every time. Every time. Why stage 2 never stops. Debasement. ISN. Incompetence. Its incentive alignment. Austerity. Loses elections. Printing postpones consequences. When spending exceeds productive capacity, reversal becomes impossible without revolt. This is why Rome clipped coins France, debased assignats vimar. Printed mucks Britain borrowed until collapse. This stage is irreversible, which leads to stage 3. Stage 3, the QIEXITVs, is the most misunderstood phase. The smart money doesn't panic. It doesn't announce. It doesn't crash the system. It rotates quietly. China didn't dump treasuries overnight. It reduced exposure gradually. From $1.316 trillion gives $688 billion. Meanwhile, gold reserves rose officially to over 2,300 tons. Estimates suggest far more. Silver consumption surged via industrial demand. Strategic commodities replaced paper claims. This isn't speculation. It's what you do when you understand. The matha incentives the endgame. The bond market still functions because domestic institutions are trapped by regulation. Foreign actors are not. Why gold and silver? Gold and silver don't require trust. They don't require promises. They don't default. Gold preserves purchasing power across regimes. Silver combines monetary history with industrial necessity. China dominates solar manufacturing. Solar panels require silver. Electrification requires silver. Digital infrastructure requires silver. This is an ideology. It's logistics. When physical demand exceeds supply, paper claims break. Stage 4, the debt SPRL. Stage 4 begins when interest consumes the system. More debt, higher yields, higher yields, higher interest, more debt. At some point, that's when real rates go negative. Capital flees. Trade fragments. Currency loses store of value function. This is not hyperinflation by default. It's loss of confidence. And confidence collapses fast. History's verdict. Weimar Germany collapsed in under 2 years. The British pound lost reserve status over decades. The gold-backed dollar died in a weekend. These transitions are not gradual. They are thresholds. Once crossed, reform stops. Replacement begins. Where we are. A&OW Stage 1. Completed in 1944, Stage 2, ongoing since 1971, Stage 3. Clearly underway. Stage 4. Approaching. Timing unknown. Interest costs exceed defense. Debt grows faster than GDP. Foreign buyers retreat. Central banks accumulate gold. The pattern is intact. The myth of this time is different. Every collapsing system believes it's unique. Network effects, military power, technology, non-stop mathematics. Empires don't fail because they're weak. They fail because debt compounds faster than legitimacy. China's move is not aggression. China isn't attacking the dollar. It's hedging against the system. If the dollar survives, they hold real assets. If it doesn't, they're positioned for what comes next. That's not hostility. That's intelligence. What this means for you don't need to predict collapse. You need to understand exposure. Ask yourself, what assets depend on promises? What assets survive regime change? What holds value without permission? That's the real question. Closing the pattern never breaks. Currencies change. Systems reset. Debt resolves one way or another. The pattern doesn't care about politics. It doesn't care about optimism. It doesn't care about belief. It only responds to math. China understands this. History confirms it. The only remaining variable is whether you see it before the threshold is crossed.